Hi, my name is Eric Chan, and I'm a portfolio manager for the Aberdeen Asian Income Fund. It's true that global tech is typically not considered a good source of income because the sector is skewed more towards software-type companies where cash is aggressively reinvested and shareholder returns are more discretionary. However, in Asia, constituents of the technology sector are vastly different, and there's much larger exposure to technology hardware instead of software, that's almost the opposite of what you see in developed markets like the US. Asian technology is essentially the infrastructure layer of technology, and those types of companies actually have a history of paying strong and sustainable growing dividends. Secondly, valuations lag fundamentals. So Asian technology stock valuations are behind those seen in the US, despite their earnings being backed by incredibly strong cash flows and a history of shareholder return via dividend payments. In fact, the income component of Asian technology stocks is only getting stronger. You've seen Japan's Value Up program has spread to Korea, China, and Singapore, and we're seeing increased dividends and buyback commitments from companies in the region. It's actually pretty hard to argue nowadays that tech doesn't yield. Lastly, despite having lower valuations compared to other markets, Asian technology stocks benefit just as much from phenomenal AI-associated growth, if not more so. AI is a very strong sector thematic that has sustainable legs, and more importantly, the AI theme is now moving beyond just hype and into actual physical infrastructure. Asian technology stocks are the picks and shovels of the technology world, and as the demand for AI applications increase, it's the infrastructure development and Asia technology supply chain which is the primary beneficiary. Asian technology companies are already seeing really strong earnings and cash flow growth on the back of a pickup in AI-linked capex and order books, and this is only going to continue into the future. Higher dividend payouts have been an important part of that change. Japan kicked off the corporate governance playbook, and now that's feeding into markets like Korea with their Value Up program. Similarly, in China, the central government is pushing state-owned enterprises to raise their dividends, which is having an impact on the rest of the country's corporates as well. I just want to point out that while a lot of the media's focus has been in North Asian countries, we've also seen a lot of shareholder return improvement in other markets such as Indonesia, Taiwan, and Thailand, which all now have strong and well-established dividend cultures. Even already kind of known dividend markets such as Singapore continue to expand their level of payouts. So how does this benefit the fund? Well, in a couple ways. First, income growth. With the reform drives, more companies are moving towards sustainable dividends rather than one-off or opportunistic special dividends. This not only increases the regular income received from the stocks we invest in, but as Asian income investors, the more the market normalizes paying dividends, the wider our investable universe becomes. We're seeing more ways to tap into the growth of Asia while still getting that healthy income. I think secondly, there's a potential for a valuation re-rating that happens. When governance reforms become embedded in the corporate structure and shareholder returns improve, there's room for a valuation catch-up for companies that have been priced as if that governance change was never going to happen. Korea is a perfect example where the market was perpetually priced cheaply, but governance reforms have resulted in a re-rating in the market. In the past 2 years, Korean corporate share buybacks or cancellations have more than doubled since the introduction of the government's Value Up program. And it's not a coincidence that the MSCI Korea index now trades at a price-to-book ratio of 1.8, which is significantly higher than its 10-year average. Now, we're always looking for opportunities to invest in strong dividend franchises, which are now more abundant in the region and are very interested if there's a potential value re-rating from improved governance and shareholder return structures. Now, this doesn't mean that every single story is real. We look for concrete proof of commitment and evidence that there are clear dividend frameworks, buyback cancellations, or return on equity targets and board independence. I'd say that last year's pullback has reset the entry point. Almost after 2025's market underperformance, India's valuation premium over emerging markets sits below its long-term average, while fundamentals are improving, providing a better balance of growth and valuation. As the cycle matures, cash-generative franchises with disciplined balance sheets should lead the market again. In other words, the market's valuation premium has cooled, and quality should be a winning style. In the near term, earnings downgrades seem to be approaching their end, and policy remains supportive. Combined with tax reforms, easier rates, liquidity, as well as a US trade deal, the Indian market is positively set up for the 2026 earnings growth. In the medium to longer term, the opportunity set is getting broader and more industrial. And that builds multi-year runways where market pricing still lags the structural shift. The one thing I'd like to caveat and for investors to keep in mind is that as an income fund, we're looking for yield, and India typically doesn't have a very high yield. It's still a pretty low dividend paying market. So it limits what we can buy as an income focused fund. But we're always looking out for those opportunities, and there are potentially more now with lower valuations. We're fundamental investors first and foremost, and we favor companies where balance sheet strength, shareholder return discipline, and cash flow visibility support both dividends and capital growth. Quality remains our North Star, and a refined total return approach combines yield and earnings growth while maintaining a quality income focus. And we're looking for the balance amongst those three characteristics. So we're always looking for companies that are strong dividend franchises at various stages of their life cycle. Some of these companies could be lower yielding, but based on their high quality business models, dividend policies, and growth potential, actually are strong dividend payers just in the earlier stages of their development. So from a stock perspective, those are the characteristics we look for. As for thematics, what we find interesting and we continue to like is the Asian technology sector, which we spoke about before. The global AI build-out continues to underpin earnings growth across Asia, and the AI opportunity set extends well beyond just model makers. It spans hardware, energy, infrastructure, and applications. Companies across Korea and Taiwan continue to be key beneficiaries of AI-driven growth, and Korea in particular benefits from that re-rating value up tailwind that we spoke about before. That being said, we are keeping a close eye on valuations. So it's a sector that we're both adding and reducing to depending on the individual stock's valuations. We also are actively looking at India for good yield names, which because of the market's lower yield has historically been an underweight position for us. However, with the valuations coming down meaningfully, despite macro fundamentals remaining strong and there's policy headroom to support growth, we're also actively looking at that market. I'd say the last thing is that we are reducing our overweight REIT exposure, our real estate exposure, partially to fund some of these other opportunities. But it's also because a good portion of our real estate is in Australian REITs, which are likely to be weak under a hiking cycle in Australia. Thank you for watching. For any more information on the Aberdeen Asian Income Fund, please visit our website.